Oh, hey, happy Tuesday, everybody. Your man Omid with you once again to try to make sense of this marketplace. Not a whole lot going on this week, so this will be a quick, short one for you. So let's dive right into it. Last week's market, if we remember, we have been trading in this tight range like this, just up and down every day. We tried to break through. Unfortunately, the 100-day moving average didn't hold us as I was hoping, and now we're way down here. So as a result, what we're seeing a sell-off on the bond market, and what we got here is last week's rate were 7.10 on Monday, and now they're at 7.14. So again, floating around that low seven. So not anything horrendous, but certainly not improving the way that we had all hoped. Okay. Monday, the market was closed. Tuesday, there's nothing going on. Fed Beige Book comes out. This is a report that comes out 8 times a year. By the way, how undescriptive or unimaginative could this be? Fed Beige Book is named after the cover of the report. It is beige, right? Okay. That's going to come out on Wednesday. It'll be interesting to see what it is that's in there, and that could move the markets up or down. Q1 GDP, this is the second reading. The first reading came in showing a miss. If the second reading comes in again showing a miss, that'll show weakness in the economy. So that'll be interesting to see. Initial jobless claims coming out again. Let me guess, 212,000 to 215,000. That's the way that it's been now for the last 11 weeks, with one exception. Pending home sales, we'll see how many of those are selling. And last but certainly not least, personal consumption expenditure, the PCE. This is the Federal Reserve's favorite way of measuring inflation. That comes out on Friday. So that'll be a market shaker. As always, if you're finding this information valuable, do me a huge favor. Please share it with one person. It's through this education that we are able to move ourselves as professionals in this business, as well as home buyers, to a different realm that we can understand kind of what's going on and the whys behind things. And the more we understand the whys, the happier we all are. Okay, here we go. HUD increases maximum fee that lenders can charge for loan assumptions from $900 to $1,800. Now, what is a loan assumption? We get this call a lot. A loan assumption is when somebody took out a loan 4 or 5 years ago, they've got a 3 3/4 rate on it, and now they wish to sell their house. And as long as you qualify for that purchase, you can take over their loan. Great, good, right? But it has to be an FHA loan, a VA loan, or a USDA loan. It has to be a government-backed loan, right? One of those things. And also remember, if somebody bought a house 4 or 5 years ago, was at 500 grand, now they owe, 350, right? And now they're trying to sell that house for 800 grand. Anyone looking to assume that loan has to come in with the delta or the difference from the purchase price to what it is that people owe. And not many folks have that kind of $300,000-$400,000 sitting around. So great idea, if you will. Not sure how much of it we see, especially up here in Washington State, King County. Okay. Something that's interesting here. There ain't no bubble. That was from last week. That should have been taken out. So don't look at that. Credit card balances. One thing I want to show you is inflation is where it is, and that's because we all keep spending money. And so the thing that's really interesting is every time credit card balance is kind of spending maxes, when it starts to slow down and peak down, that's when the recession kicks in, right? So there's lots of things that show us the recession is coming. This is one of them, and it is like clockwork, right? Credit card balances up, starts to kick down, boom. Credit card balances up, starts to kick down, recession. Up, starts to kick down, recession, and now up, and now we are kicking down some. If you ask me why this happens, well, I think people are spending, and then they get to a place where like, oh my God, I can't go into debt anymore. They stop spending. That stopping of the spending means that they're not going out after work to have a drink, to have dinner, to buy that pack of smokes, to go to the movies or whatever that is. And all of those businesses and all of those employees of those businesses are seeing less hours, right? So all of these things kind of puts us into a recession because there's not as much cash floating around. Another thing that's really interesting for you to see is U.S. personal savings rates. We are now really bottom of the barrel, if you will, all the way back to 2004 is the last we saw. Anything lower than this was really, what was that, 2004, 2005, right? And savings rates are also a good indication of when and where we are going into recession. This 34% wasn't an anomaly in my opinion. This was where we were getting pandemic relief, et cetera, that was happening right after COVID. But and people's bank accounts were high because they had nowhere to spend it and nothing else to do with it. So with that, I wish you a great week. As always, we're here to help you if you run into things that you can't structure and figure out how to make somebody's payment work out. we are the #1 source for that. So definitely pick up the phone and give me a call. Okay. Thank you as always. Subscribe, like, and comment, and share, most importantly, these things so other people can become as smart as you. Okay. Have a fantastic week. Chat with you soon.